Welcome to OUP, and today we're going to talk about various ways cap tables are built around startup companies and how these cap tables play out in various exit scenarios. We're going to use Biostar Biotech as our hypothetical company and build a cap table through a series of financings, some good, some not so good, and a series of exits, some good and some not so good, just to illustrate how some of these terms and capital structures are relevant in the end game. So we'll start with our base case, very simple case. As with many university spinouts in biotech, there was a new biology insight, a new target identified in the RAS pathway. The university was granted a 10% equity position in the company, founder stake based in the license agreement, and the university has a 10% percentage participation right that was assigned to OUP. So pretty standard table stakes here. On the next slide, you can see the founder's allocation. So the university has a 10% stake, the founders obviously 90%. And arbitrarily, the company was capitalized with 1 million shares of common stock. No money was invested. This is just allocation of founding shares. So one of the local angel investors happens to be the brother-in-law of one of the founding scientists. I heard about this over dinner and decided that they would like to invest $100,000, and negotiating with the founding scientist, he negotiated for 20% of the company. So this essentially places a value of $400,000 on the company prior to investment. So a pre-money valuation of $400,000. The $100,000 of cash that's going in gives the company a post-money valuation of $500,000. The angel was buying common shares. We'll talk about preferred shares later. And typically, OUP does not invest alongside individual angels, and we really don't purchase common shares. So we didn't exercise the right in this case. We chose to have this seed round be priced by an angel. In fact, most of the time, and I think largely for good reason, these early seed investments come in the form of a convertible bridge loan, where technically the money is a note that's repayable and converts into the next financing round, typically at a discount between 20 and 25, sometimes as much as 30%. And the idea is that these individual and early stage angel investors don't want to place a price on the company that might be too low, because then the company's unhappy as they're giving away too much of the company, nor do they want the price to be too high, because when they go out to raise a real venture capital round, the VCs may cram that valuation back down or just walk away if it's too high. So it's generally a good idea to take this money in the form of a convertible note and put a price on not put a price on the company. Here we elected to price it just so you can see what happens if in that situation. After the seed financing, this is what the capital structure looks like. So we still have the common shares. Those don't change between the founders and the university. Now the angel has put a value of $400,000 on that pre-money million shares. He is investing $100,000 and purchasing 250,000 shares. So now we have a total number of shares of 1.25 million. The implied share price is 40 cents a share, as you can see. So here, the pre-money 400, investment of 100, and the market cap is 500. The angel investor owns 20%, and you can see the founders are diluted from 90 to 72%, and the university is diluted from 10% to 8%. This is a pretty standard, simple investment capital structure. Moving on, the translational experiment was successful. A local venture group, Alpha Ventures, likes what they see and wants to lead a $5 million Series A round, so a true venture capital round. They've put a price on the company of $5.25 million as it stands, so that's the pre-money before any Series A funds go in. And they want to include an option pool, so unvested options available for issuance to a management team that will have to be hired because the two founding scientists are not leaving their day job. They put a price of $3 a share, and they are buying preferred stock. So this is convertible preferred stock. It has a 1x liquidation preference, so a standard liquidation preference, which means the investors can take their invested capital back or convert to common and share in the proceeds of the company at exit. We'll talk about that and see how that plays out later. In addition to liquidation preference, the preferred stock has an anti-dilution provision. Here it's weighted average, which is typically seen. This essentially changes the conversion price for the Series A, or the number of shares bought in the Series A round, if the company raises money at a lower price in the future. And it takes into account, in a weighted average fashion, how much money is raised in the future, how many shares are issued relative to the outstanding capital stock of the company. If the company raises a lot of money in the future at a low price, it has a more profound effect. If it's only a little bit of money at a lower price, it has less of an effect. One thing to keep an eye out for is a more draconian form of anti-dilution, which is full ratchet. And in a full ratchet anti-dilution provision, if the company issues a single share at a lower price in the future, all of the Series A, in this case, subject to a full ratchet, would convert at the lower price, and this can have a devastating effect on common shareholders. So full ratchet, you want to keep an eye out. And this money, $5 million in the Series A, is being used to fund a proof of concept study in an animal model and trying to nominate a development candidate. This is a type of round that OUP is very interested in, and we did in fact exercise our 10% participation right. And the cap table now changes, as you see in the next slide, after Series A. Again, the common shares haven't changed between the founder and the university. Remember, the new investor wanted a 15% option pool, so there are shares to issue as options to management. So that adds 500,000 shares in the common pool. Remember, the angel bought 250,000 in the seed round. Those are still there. So then the total number of common shares has increased from 1.25 to 1.75, and that's just over half the company. $5 million was invested in the Series A at a $3 share price, and OUP exercised its 10% participation right, putting in $500,000, and you can see the preferred A shares purchased by OUP and the preferred A shares purchased by Alpha. So the total number of preferred shares is about 49% of the total capital of the company, and outstanding shares of the company rather. And you can see the fully diluted ownership on the far right. So the founders have now diluted from 90% to 72% to 26%. The university's down to 3%. The pool we just put in, the angels diluted, and you can see OUP bought its 5% and Alpha has 44%. So this is pretty typical for a Series A. The angels here, had this been a more traditional convertible note, would have converted that $100,000 into the Series A at a discount, generally 25%, 20% or so. So they would have bought some shares in the Series A, but for purposes of illustration, we had them buy common stock in the seed round. And these are standard preferred terms. We talked about a single liquidation preference, so you get your invested capital back, and weighted average anti-dilution. So the company proceeds, they make progress, they do nominate their lead. Beta Ventures now, which is a bigger firm, is very interested and wants to lead a $30 million Series B round. they would invest 20, the existing investors would invest 10. Typically, there's an expectation that the existing investors will participate, and in fact, the more they participate, the better. General rule of thumb is 50% of the round is a real show of strength. Here, beta just wants more, which you also see. Greed is very common in our industry, surprisingly, and beta wants to do 20. They have put a valuation now on the company of 25 million, so a meaningful step up from the Series A. And they said, well, at this higher price, we can tolerate a smaller pool, so we'll let it drop a little bit, but we still think we need 14% of the company to allocate to management. We're twice the share price. Remember, the Series A was $3 a share. We're going to now pay, as Beta Ventures, we're willing to pay $6 a share, but we want a participating preferred stock. So this liquidation preference term not only gives us our money back if we want it, but we have the option of taking our invested capital back and then converting to common and participating on a pro rata basis in an exit scenario. So it's a little bit of a double dip. So we essentially get 1x return in any scenario that provides that much capital to the company. And this is far more attractive for a venture investor, less so for the company, but is very common, particularly in biotech. This also has a weighted average anti-dilution, which is almost always the case. And these funds are going to be used to finance a phase 2A clinical study. The hope is that with 2A clinical data, the company could transact. So now we get to the cap table after Series B. It's looking more complicated, but only incrementally so. In the column, the common column, you can see the founders, the university, those numbers haven't changed. The original shares in the pool, some of which have been allocated to the emerging team, are still there, the 500,000 in the A. Now with the B, we had another 750,000. We're going to have to give some shares, or options rather, to the management team to offset dilution, and we're going to expand the management team so we have new hires. The angel hasn't changed his 250,000 common shares, and because he invested in common, he does not have a participation right or a pro rata right to participate in the preferred rounds. You can see where OUP and Alpha bought in the A. You can see now in the B, OUP is investing its 10% right, so 3 million of a $30 million round. Alpha put in 7, so the balance of the 10 from the insiders, and then Beta invests 20 million. This was done at $6 a share with a pre-money of 25. Investing 30 gives you 55 million of post-money valuation. So the company, this round values the company at 55. And if you notice at the bottom on the preferred B, you can see the shares that were purchased in the B round by OUP, Alpha, and Beta, total of 5 million shares at $6 a round for 30 million. And this is participating preferred, so it's not standard preferred. Standard preferred gives the investors the option to either take their investment back or convert to common. Participating preferred, they get both. They get their investment back and they still convert to common and participate along with everybody else. You can see the fully diluted ownership has changed. The founders are now down to 10%. The university is at 1%. The pool by design is 14%, and you can see where the angels, OUP, Alpha, and Beta are. So the angel here, because he purchased so much of the company at such a low price so early, is doing pretty well, far better than the university. So as we now move forward, we find Biostar is successful. As we thought, the phase 2A data triggers interest from Big Pharma, and there is, after some negotiation, $250 million cash, all upfront transaction to acquire the company. So the question is, how does that 250 get split up? You got to look to the cap table for that. So here's the payout waterfall. Remember, we start with the most recent series or most senior and work backwards. So Series B was 30 million. You can see OUP invested 3, Alpha invested 7, Beta put in 20. So they get that back. That's this participating preferred. So in any scenario, as long as there's any money available, it's divided up first to the Series B investors up to these amounts. So there's 30 million goes to the Series B. Out of 250, that leaves 220 million to distribute. Then the Series A investors look and say, okay, do we want to get back what we invested in Series A, or if we convert to common and share on a fully diluted ownership basis, pro rata, is it a larger number? In this case, it's a much larger number, so they convert to common. They don't get the participating feature that the Series B does. So they all convert to common. OUP, Alpha, and Beta convert our Series A shares to common. You can see the fully diluted ownership percentages in the next column. That's once converted to common. And then just multiplying that by 220 million, you can see the founders do pretty well here. They take 22 million home, the university gets 2.2. I'm ignoring any allocation or sharing arrangements within the institution. The pool, the management team gets 30.8, so they do pretty well. This angel does pretty well considering he only invested $100,000, and then the rest of the investors do pretty well in the 5 to 6 times their money range. So a good venture return, an unbelievable return for the angel. This is one of the reasons you don't price these rounds, as obviously some of that money really should be in the hands of the founders and the university. So this is a great outcome. Everybody walks away happy. There's a little bit of head scratching around why the angels did so well, but in general, this would be a great return and everyone would be happy. So let's look at some other scenarios. So if we go to a down round, so something happens and the company has to raise money at a lower price. So there's a setback. The phase 2 data, rather than being positive and leading to an acquisition, it's inconclusive, doesn't meet its endpoints, although a post hoc subgroup analysis, which is always done, identifies a subpopulation of patients where there was some efficacy signal. The FDA won't let you really use that in any kind of approval, but it is information that can be helpful. The company puts together a second trial design focusing on this subpopulation, pitches it to VCs and Gamma Ventures, says, you know, we really believe this signal and we are willing to fund a $30 million Series C financing, but you've spent all this money and we're gonna drop the share price to $1.31. So remember, the share price in the Series B was $6 a share, so this is a pretty dramatic down round. So the pre-money is 12 million, and they realize there's a bunch of shares out there, and they agreed for a later stage company like this, a 12% pool is sufficient. So they want to add shares to the option pool to get the total number up to 12% fully diluted. Gamma said, hey, you know, this is a higher risk now that we're in Series C and we're doing this restart. So we'll invest 15, but if we're going to do 15, we require the existing investors to invest 15 and split this and share the risk with us. It's a participating preferred stock once again. Once you have that participating feature in the cap table, it's unlikely future investors will take anything less and move to a standard preferred stock. And again, weighted average anti-dilution, which you almost always see. And the idea is this would fund a second phase 2 study with new inclusion-exclusion criteria reflecting this subgroup analysis. So what does that cap table looks like? It's starting to get even more complicated, but if you start with common, essentially those numbers we've seen before, or adding 300,000 shares to the pool, because remember, we're now dropping the value down quite a bit, so to get to 12%, we don't need as many shares. You can see the preferred A shares are still outstanding. Those haven't changed. The preferred B shares are also still outstanding. They have not changed. That's where the participating preferred kicked in. Now we look at 30 million invested in Series C at a down round price. So at 131 versus $6 in the B. We left some of the prior round share price numbers off just to avoid confusion. So OUP invests $1.5 million, Alpha invests 3.5, Beta 10, Gamma 15 for a total of 30. And you can see the number of shares we each purchase, and then fully diluted ownership, including the A and the B positions, and for the angels, founders, and university, and the pool of the common. So the university is now rounding to 0, although it's not truly 0. And you can see there's been pretty profound dilution for everybody, including the angel at this point. One thing to note here for OUP, Alpha, and Beta, although our prior positions were diluted heavily as preferred shareholders with pro rata rights, we can buy up our ownership and maintain some fully diluted ownership to hopefully buy ourselves out of the hole. So the cap table is starting to look a little more complicated now, and not so good for the founders and common shareholders after the down round. What's not included here, and we didn't include it just because it's a little too complex and the math becomes confusing, relates to the weighted average anti-dilution provision we discussed earlier. So not only does the Series C at the lower price shift ownership from common and earlier investors to the Series C investors, but now the A and the B investors take a look at the new price, $1.31, what the old prices were, $3 and $6. And although it's weighted average, which is very common and generally pretty balanced, the fact that so much money is invested at this lower price, there's 30 million coming in, and many shares, 22, almost 23 million shares are being issued, that the impact on the Series A and Series B ownership is meaningful. So in the case of Series A, you'd go back, recalculate a conversion price that would drive the price down significantly from $3 closer to $1.31. As a result, there'd be additional shares issued because remember, in a weighted average anti-dilution scenario, the money that was invested back in Series A, that $5 million, would be as if it was invested at a lower price that is calculated on a weighted average basis. So additional shares would have been purchased. Those shares are now added to the cap table to the Series A preferred shareholders. Similar thing happens with Series B. That $6 price is now effectively lower on a weighted average basis, and additional shares are issued to the Series B shareholders as if they originally purchased their 30 million that was invested in Series B, originally purchased shares at the lower price. So although it's not shown here, and this is fairly dilutive to the founders, common shareholders, the Series A and the Series B here get additional shares, which further dilute the common shareholders. And that's something to keep in mind, that even with weighted average anti-dilution, which is almost always a feature in a preferred share of preferred stock, in the event of a down round, particularly a down round at this lower price relative to prior rounds, and for this much money, it will have a meaningful impact. As we move then to the next slide, success once again with these adjusted inclusion-exclusion criteria. The phase 2 study is positive, and in that indication, once again, the company is acquired for $250 million cash up front. So how does that play out now after the down round? Because some things have changed pretty dramatically. So on slide 18, the payout waterfall for the $250 million after a down round is a little different. So We start again with Series C. Remember, this is participating preferred, so that Series C 1X, so 30 million comes off the top. And you can see that that comes back to the investors according to the amount they invested. So that 250 million is now 220 million. Series B was participating preferred as well. Another $30 million comes off the top after the first 30. So that takes it down to 190 million. Series A once again looks and say, hey, if we take our position and convert to common, does that give us a larger payout than if we just took our invested capital back? Because they only have a 1X preference. They don't have the participating feature. And in fact, converting gives them a greater payout. So the Series A convert to common, and then everybody shares on a common, as converted to common basis. The FDO, the fully diluted ownership column, shows you on the basis of how they share and relative to one another. And then as you multiply that through by 190 million, you see the founders get just under 5 million, the university gets 500,000. Management team does okay, because remember, they had the pool replenished, not as well as in the all upside scenario, but still not bad. The angel is cut back quite a bit, though on a multiple basis still does pretty well, again, because in this case it was priced too low and the university and founders gave up ownership too early. And then again, OUP and Alpha, although we were Alpha and Beta rather, all three of us participated in the investments in the A and the B before the failure, but by our ability and right to participate in the C, we're able to buy our way back to reasonable, though not great multiples. 2.5 to 3 is good, not great. Gamma, because they came in last, is a 5X multiple, and they're very happy. So looking at what the implications are here, you can see that the investors have the ability to continue to buy their way out in future rounds. The most recent investor obviously does best, and then the common shareholders are kind of at the mercy of what's happening above them in the cap structure. And just to remind you that this payout waterfall, again, for purposes of illustration and simplicity, does not include the anti-dilution shares that would have been issued to Series A and Series B. Those shares would, in fact, shift some economics from the founders and university and the pool, for that matter, toward the Series A and Series B investors. So let's think about another scenario here. What if there's a failure? So that do they fund the second 2A study, but it's negative as well? So now we have two phase 2A studies that are negative. But as often occurs with these deep science university startups, continued research has identified additional molecules against this new RAS target. And there's some promise in some very early preclinical studies. The company tries to pitch that to the venture community, can't do it. But pharma says, we kind of like this target. There's great seminal intellectual property here, which is often the case in university startups. And we think with our internal medchem efforts and biology capabilities, we can take this preclinical program forward. And the company's acquired for 40 million in cash up front. In all of these acquisition scenarios, we're assuming it's cash up front. In most biotechs, if not all, there's an upfront and then a series of contingent and milestone payments, which gets just too complicated to go through in this sample problem. But for now, it's 40 million upfront. So clearly a failure, but not a total write-off. So what happens now? If you look at the payout table, you go back and start with Series C, because that's most recent. Remember, that was a $30 million investment across 4 funds. So that Those funds all take back their original invested capital, so they're 1x. And you can see how that pays out. Then Series B has to decide, gee, do we convert or just take our money back? Obviously, they take their money back because there's only 40 million to go around, and 30 of it's been taken by Series C. So there's only 10 million left. So if you look at the Series B, the third column, that's what was invested. If you apply that, so that was 30 million, you have to cut that by a third because there's only 10 million available. In the fourth column, the Series B proceeds, you can see what is actually allocated to those investors. Then you go to Series A because they're next, and the preferences are 0.5 and 4.5. That was the 5 million invested in Series A, but guess what? There's no money left because the C and the B took it all. So Series A gets 0. So then you go to a fully diluted ownership after Series A, and you see the founders and the university, the pool, all those ownership percentages are irrelevant because there's no money left to pay them. And the angel in this case gets nothing because he had purchased common shares. So if you look at the total payouts between the Series C and Series B proceeds, OUP, we don't get back our investment, we get back 0.7. Alpha gets back 0.5, beta gets back 0.8, and gamma gets their money back. So they get their whole 15 back, which is the purpose of a liquidation preference. And then the university, the founders, and management team get 0. Now in practice, a deal like this would require what's called a carve-out for management, because the management team would not actually execute the transaction and follow through to sell the company unless they were going to get something from it. So there generally would be, you know, call it a $5 million carve-out to pay management, something of that order. But this shows that in a down round, these liquidation preferences can really suck all the air out of the room. And there's really very little left for the early preferred investors, let alone common investors or founders, and the universities at the very bottom of the stack. In this scenario, as opposed to the success scenario after a down round, because there's so little cash to distribute and it all is taken out in the form of liquidation preference, none of it's distributed pro rata on a fully diluted ownership basis. The anti-dilution shares that aren't shown here that would be added to the Series A and Series B preferred shareholders are irrelevant in this payout because all of it comes out in the form of preference and relative ownership of common stock on a common stock equivalent or fully diluted basis, does not figure into the calculations for distribution of proceeds. So on the next slide, we just look at the return comparisons. Remember, we had a base case, which was everything looked great. We sold it for 250 million. The down round scenario where there was that extra Series C at a lower price, but again, a good exit, a $250 million exit. And then 2 failed trials and a $40 million exit to point out the comparison across the 3 scenarios. For the investors in the initial scenario was pretty attractive, 5 to 6x. The angels kind of out in space with 66x. In the down round, the angel still does pretty darn well. The venture investors are mediocre. And then in the final case study with a $40 million exit, you know, the investors get back some of their money. The most recent investor gets back all of their money, and there's very little left for anybody else. So it just points out it's very important to pay attention to these things, and down rounds do have consequences. You always want to look at the liquidation preference stack that sits on top of the common shareholders. Management teams do that all the time. And then for the founders and the university and common shareholders, thing to keep in mind is there's no way to buy up in trying situations. It's kind of only downward motion in terms of returns, and that's something to keep in mind. Investors, management team through the pool can continue to increase their ownership through a series of down rounds. Most companies do go through hard times, and one down round can really wipe out the founder group. So I hope that's helpful. And if there are any questions, you can always reach us at OUP. And again, this has been Bill Harrington. Thank you for taking the time, and I hope this has been helpful.